All right, well, listen, Christmas has come early for the housing market. Mortgage interest rates have fallen more than 1% in one day because it's what day? November 10th. The new CPI report has come out. And, oh, by the way, I have to have a little "we told you so" moment. You know, I hate to act so maybe, I don't know, childish about it.
Yeah.
But you know what I haven't seen today? I haven't seen any videos from all our fear-monger buddies about interest rates. Yeah, but what happened? Where are you guys all at? So anyway, I digress a bit. However,
it also saved us today.
Yeah, it saved us.
We also do not look. Today is also Christmas for not looking like a complete dipshit.
Great point. Because had rates gone up today, maybe everything you and I would have said over the last couple of months, we would have looked like absolute schmucks. But to our luck, the bond market had a little boner today.
That's right.
So let's show them the boner. And Mr. Frost, walk them through the boner they are seeing on screen now.
So this is what we look at as a mortgage-backed security, basically like the mortgage-backed security prices. So you can see in the upper corner, it says the 200 basis points. So that represents today. So we got CPI came back favorably, right?
Yes.
So it came back at a growing a lot less than we thought, or not a lot less, but growing less than we thought, and replacing that higher number that we kind of hung our hats on.
You want me to show that?
Yeah.
All right, let's get into it, just so they can see what you're talking about.
So inflation this month grew at 0.3%, and last year at this time, inflation grew at 0.6%, right? So yes, prices are still high, and inflation's rising, but it's not rising at the same year-over-year rate as it was this time last year. So that tells the Fed and it tells the markets like, hey, all these things that we're doing, the raising rates and quantitative easing and just overall being scary and doing all of these things are working. People are starting to hold on to their money. And there's a report before this today, too, that came out, which was the unemployment reports. And that came in, or first time unemployment filing or something. Sure. But again, you call it a canary in the coal mine for a recession, right? Yeah. So there's some of these recession things building, and I'm sure everybody's read about what's going on, especially in big tech like Meta laying off 11,000 people.
It's craziness.
They're like bulletproof companies, right? So anyway, what we did is we replaced this number, and that's really, as we've talked about, that is what drives interest rates. It's not, the Fed doesn't drive interest rates. We told you that. They drive on the same road running after the same storm, right? Like interest rate, the inflation pushes rates and the Fed chases inflation and tries to raise rates to get it down. As soon as inflation starts to fall, we'll see mortgage rates fall. So that's what happened today. But as far as like the swing, so if you go back to your chart, so normally in a day, like a regular day of trading, you might see like a 15 to 20 basis point fluctuation, where today we saw 200 points to the better. So we went from locking loans at varying terms, earlier in the week at 7 to 7.25% today, looking at rates at like 6.25 to 6 3/8, 6% in some cases. So
that's incredible, because here's the thing. We've been sitting here on camera for months, and I will venture to say getting our teeth kicked in from people in the comments saying you guys are absolutely out of your minds.
Yeah.
Interest rates are going to 10, 12, 14%. You guys are insane. And we were you and I, after the show, would always be like, well, November 10th is going to come, and we believe it's going to be Christmas for the housing market. And thankfully, it showed up. Now, there is something to be said that it could have even been better than it was today.
Yeah.
So let's talk about that a little bit.
So one of the big, and this is getting like deep in the weeds, right?
That's all right.
One of the big things that drive.
Hey, we got good news to share. We're going to go deep on it.
I could go in the weeds?
Go in the weeds.
Everybody go back to sleep. So everybody's sleeping good today. But so one of the things that really drives rates or drives the core inflation number is what we call shelter cost. Shelter cost is essentially where rents, and anytime you have a roof over your head, the cost of doing that has an impact on inflation. And it's the biggest driver of core inflation. It makes up 39% of the core inflation number, right? So there's overall inflation, which includes everything. And then you have core inflation, which strips out food and gas prices, because we can't control food and gas prices. The one thing that's in here, though, and you're showing it now, I think, is it on there now? So is shelter. So you're looking at increases month over month in rent, which you're seeing was up 0.8 or 0.7%, or 0.8%, then rents 0.7%. and then this OER, which is basically, it's like lodging away from home. And so that's like hotel prices and things like that get factored into the shelter costs. So as people begin to spend less money on vacationing and those shelter costs, especially now that we're in, like, everybody that's staying somewhere for the holidays, guess what they did in the month of October or the month of September? You booked your hotels.
Absolutely.
Everywhere you're going, right? And
That's
it's a really
point.
costly time to go on trips. So this is one of those things. It's a big lagging indicator. So this is like one of the last things that will start to make the turn coming down. And a lot of that is because, like, if you look at rents, those are year-long agreements, right? Where you're paying rent. So that rent number stays higher. So as a lot of these long-term leases that last year, when inflation really was really on a run, right? We replaced that 6/10.
Yeah.
We think about all the lease agreements were signed then, we're also at peak lease rates. So now we're going to see all these lease agreements turn over and start turning over to some of these lower numbers.
So I want to go back to this real quick. So is it safe to say, objectively, without the emotion, that inflation has peaked? But because of the report that's come out today, this objectively shows inflation coming down. Is that correct?
Yeah. And even like last month, we saw inflation essentially peaking.
Sure.
But it was still higher than it was last year. And does this mean that, like, there could be economic data that comes out next week that rates come up?
Absolutely,
Monday
for sure.
morning, the markets could open and we could lose some ground.
Yeah.
And it's so it's not saying that, like, rates are now going to fall to 4.875. Maybe they do.
Right.
Who knows? Like, we're legitimately going into these months now where things are getting, like, the layoffs are going to continue to grow and the Fed is going to continue to tighten our monetary policy. So we're going to continue to, like, the reason inflation grew less this year than it did last year is because of the Fed.
Right.
And the Fed is doing more. And what the Fed does takes several months to actually turn into something, right? To convert, right? Like, we talk about conversion all the time, right? Like, Fed conversion, super slow. It's like 120-day lead time, right? So as they start to get to that point, we're going to start to see inflation numbers coming down and down and down. So objectively, rates should be, like, we should have hit the peak, and rates now, like, there's going to be some ups and downs, but generally that trend line should start to move down.
Yeah, based on the information that we have today, I think is what you're saying.
Yeah.
With the information we have today, there's, of course, things that could happen that we don't know.
Right.
But putting that aside for a second, with the information we have now, would suggest that the peak of inflation is in the rearview mirror.
Yeah.
And that everything the Fed has been working on, all of the pain that we all have been going through over the last couple of months, we're starting to see the tides turn just a bit. So this is where we see some economists who say, well, we may see rates in the 5s yet in 2022.
Yeah.
It's because of the CPI report that we got today.
Right.
So let's look ahead. So first point.
Let's think about something.
Go ahead.
So if we saw, just so to put it into perspective, right? So if you're an agent out there, or you're a home buyer out there, or you're a loan officer out there, and you're like, okay, what difference does this make? So if you think about a $300,000 loan,
huge difference, but go ahead.
Coming down 3%, or coming down 1% in rate today. So it's super easy math, right? It's 1% times 300,000 is $3,000.
Sure.
Divided by 12 is $250. So literally, think about the affordability of that. Like, I know we're far away from the lows, but we're certainly not that far from the norm. You know, like, we're far from the anomaly.
Yeah.
Like we talk about, right? But right now, I mean, $250 a month savings in a day for that person is huge.
It's massive, Steve. And here's the thing. It's, to your point, last week you're locking loans at 7.25.
Yeah.
In one day, I'm going to pull this back up because I want people to understand. I love calling this thing. Yeah. I want them to understand how impactful this boner really is.
Right.
November 10th. Look at the growth in the bond market. I mean, we can go all the way back to, what is this? Back into August. We've never seen growth like this in one day. That's why I called you and said, hey, let's make the show tonight instead of tomorrow morning, because I want to get this video out right now to the people so they understand, wow, in one day, mortgage rates went from 7.25 to 6.25, right?
Yeah.
And right now, as we're making the video, right, so no BS, the bond market's over 200 basis points higher.
The interesting, too, is the 10-year.
And it keeps growing.
If you look at the 10-year Treasury, too, which rides with rates really closely, I mean, we were looking at we're looking at this 10-year treasury playing around like a 430 number. I mean, so we broke, there's some moving averages we look at a lot here where you can see this line. We really had a hard time with the info that we had, whether we were getting good news or not, or there were good trading days or good auctions in the market. We weren't breaking below this 25-day moving average. You can see every time we got close, we bounced off. And today we just fell right through. And we had a lot of room to move because you go through to now a 50-day moving average, right?
Yeah.
So you've got a lot of room to move through there. Well, if you think about it, any more good news toward the inflation side of things, look below that. I mean, you've got a whole nother day. That would be a whole nother, if you're looking at it in the same context as a mortgage-backed security, you're looking at almost a full percent again in rate. So think about that. That's just like it's just kind of an interesting time. And does that translate to people buy, like, I'm going to buy a house today? No, probably not. But this is stuff that you want to get out to people and say, like, look, this, as bad as we thought this was, and look, nobody wants to go through a recession, but you have to understand that this is what a normal recession feels like. It feels like a 50% off sale at your favorite Instagram ad store 2 weeks before Black Friday.
Yeah, that's a good
trying
point.
to bring like sale, like in the last 2 years, like nothing was on sale. Right. So a recession, you're going to find things on sale. You're going to find things you're not going to find 10, 11, and 12% unemployment,
right?
Which is a totally different world.
Yeah, I mean, I think that the point is that most of the people that would watch the show, I mean, I told you about a phone call I had with one of the top agents, real estate agents in the state of Michigan, and they had no idea that mortgage rates did what they did today because of the bias that the media does such a great job of, like implanting in everyone's mind how bad the market is and how high interest rates are going to go and the market's crashing. Honestly, people believe that in their soul. Right. You want to show something?
No.
Okay. So you were having a conversation. We'll just leave. We won't have any evidence of the who, but you were having a conversation with another person who.
I'm with every day.
well, we'll just, we'll just say is responsible for a lot of real estate agents,
right?
Who almost, I don't know, did the person not believe you? Like mortgage rates went down today. When I said this to the person in my conversation, it was like the person was almost like you're lying,
right? It's the same thing. Like they're like how much? Like, what's the big deal?
Yeah,
right?
What's the big deal, right?
Yeah,
so let's look ahead for a second. So the Fed meets again December 14th.
Yep.
We believe that they're going to raise the Fed rate yet again, probably by, 50 basis points, probably.
0.5%.
And the thing that's important, they're doing that again to fight this inflation. So let's actually kind of bring this graph back up.
What's important to remember is that inflation, so we're looking at, core inflation, but the actual inflation is still 7.7%.
Yeah, for sure.
So it's still a high, like inflation is still at a multi-decade, like if you read the headlines, and like whether it's like Market Watch or the Wall Street Journal or Yahoo Finance, whatever you're reading, it's inflation still at multi-decade high, government can't get spending under control, blah, blah, blah. It's like it's still all this bad news, but nobody's looking at the fact that like, what they're doing is actually working. Nobody wants that news, and that's the problem.
That's exactly the problem.
So sold on that.
That is why we have this show.
Yeah, thank God.
Yeah, I mean, what would people do without our show?
I don't know.
But so let's just look at this one more time.
Yeah.
So we just replaced October 2021's number. We won't get the CPI report again until when?
I just did a tick. Sorry.
Yeah.
So it would be probably like middle of December.
Okay. All right.
So it'd be after their next meeting. So the next
and we're looking to replace this November number, right? So, and we anticipate that to be even lower.
Right. And again, they're going to raise the rate 0.5%, as we saw last time. Or that's what they're like. There's like a Wall Street bets that gambles, like they figure out like the odds of what they're going to raise.
Sure.
So the odds are in favor of them raising rates 0.5%. And that can happen. That's fine. The markets, what's happening today with rates is already planning on that 0.5%. That all happened last week, right?
Yeah.
But it's what he says in his press conference after. He says, because the other part of it is when he does his press conference, now the markets, because of what happened last week, which was pretty brutal, the way the press conference went, is now people are expecting for him to come out and say, and not admit it. He's going to come out and say, look, inflation is still very high. We need to have a very restrictive monetary policy until we reach our target inflation number, which
Wow,
is
you sound
2%.
just like him.
Yeah, that's
That
exactly
is your
what
uncle, so
I could do it. Yeah, I could get right in there with JP. But that's there. He's going to come out and continue to say that. But any inkling of him saying like we're happy with this or we feel like what we're doing is working is, again, it's going to be another party.
Yeah.
You know, for Wall. I mean, if you look
Absolutely.
at like your, you know, if you actually look at your brokerage account, like it's not that. I mean, today helped.
Today was a
better
great day. Today's a great day. My wife showed me. She's like, "Look, see?"
Yeah. I deleted the app.
So, anyway, this is great news. Mortgage rates came down. I will say a full percentage point in one day. The market, or the bond market's now up 206 basis points. We got 30 minutes to go until the market closes. It'll be interesting to see how high the bond market gets and how low interest rates will go. And we'll report back. But I wanted to make sure we got this out.
3-day weekend to lock loans. You got a 3-day weekend.
I almost
to get
forgot.
people under contract.
That's right. So that's the takeaway from today's video: is all the people that might be on the sideline, get them locked, because Friday we have a holiday and the market's closed.
Yeah.
So get your clients off the fence, get them locked, get them to a great loan officer like Steve, and we will continue to bring you guys the news.